Since we are looking at general deductions, one of the most important requirements for an expense to be deductible is that the taxpayer, aka our person, must be carrying on a trade. And a trade essentially refers to the type of business or enterprise that the taxpayer has. And this can be, for example, a general dealer, a farming operation, a hair salon, car wash, etc., etc. So before a taxpayer starts trading or starts a business, the taxpayer first has to decide what enterprise type he or she will use. And we've got a few. We've got a sole trader, a company or a close corporation, a partnership, or a trust. And we are going to have a look at some of the factors that taxpayers or persons need to consider when selecting an enterprise type. Some of the factors that taxpayers need to consider when deciding in what type of entity or what type of business to trade are things like limited liability, legal requirements. Do you need to or want to appoint an auditor? The risk of failure. Do you want it to be limited to the assets of the business, or are you willing to take the risk that it affects your personal assets? Things like the protection of beneficiaries. Do you have children or heirs who need to be protected in the case of a business failure? Are you thinking about providing provision for your retirement? So as an entrepreneur, if you're a sole trader, will you be able to sell your business to fund your retirement, or do you want to have continuity? Is it a family business? Does your entity type allow for succession planning? Taxes. What are some of the income tax and estate duty implications? What about things like VAT? Are you looking for flexibility? So is it a very fixed structure, or is there, do you have freedom and flexibility in the way that you conduct business? What are the admin and compliance requirements, and, what are the costs associated with starting and ultimately running the business within a particular entity type? When you think about the factors that are considered in deciding what type of entity to trade in, what you need to understand is that the tax tail cannot wag the business dog. Now, what do I mean by that? It means that tax is not the only factor to consider when selecting an enterprise type. If you choose a business entity based on tax considerations only, your business will most likely fail. Again, if you make the decision to run your business through a company because you think that is going to give you the best tax options, then your business is most likely going to fail. You need to look at those other factors when deciding in what type of entity to run your business. Tax is just part of it, but tax cannot be the deciding factor. Our first entity type, although it's not really an entity type, is sole traders. Now, a sole trader is a natural person like you and I who live and breathe, who conducts business in their capacity as a human being, and they're also known as sole proprietors. Very important, a sole trader or a sole proprietor is not a separate legal entity from its owner, from the natural person that trades as that sole proprietor or sole trader, even if it has a different name. So I could be, Michelle Hubert, but my business's name, that I conduct as a sole trader would be Michelle's Cupcakes. The fact that there's a different name doesn't mean that there's a separate legal entity. That business is me, Michelle Hubert. All business profits are taxed in the hands of the natural person, the human being, the sole trader or sole proprietor. And a sole trader, being a human being, being a natural person, is entitled to all tax benefits like, the specific exemptions and rebates that a regular natural person gets. Very important to understand from an accounting perspective, when you look at a sole trader, you do have drawings. It's not the drawings, the money or the assets in the business that the natural person uses for their own private purposes, that's taxed. It's all profits that are taxed. Think about your gross income definition. Everything goes into gross income, unless, of course, it's capital in nature. And a sole trader, being a human being, is taxed according to a progressive scale. Another entity type is partnerships. Now, a partnership is essentially where a natural person, a company, or a close corporation, or a trust conducts a business in partnership with another person or persons. Very important, each individual partner is the person for normal tax purposes, and is therefore the taxpayer from SARS's perspective. So your partnership, the business can have a name, but there is technically no separate legal entity. Each individual partner, whether that is a natural person or a company, is going to be our taxpayer or person for tax purposes. So when we look at the tax consequences of partnerships, the taxable income of the partnership is calculated separately and then added, or subtracted in the case of a loss, to the other income and expenditure of each individual partner. A natural person that is a partner in a partnership is entitled to all the regular tax benefits that any other natural person is entitled to, like your interest exemptions and rebates. And then the tax rate of each individual partner is going to depend on the type of person that the partner is. So in the case of a natural person, similar to our sole trader and sole proprietor, it will be our progressive tax tables where they taxed at a lowest rate of 18% and taxed at a maximum rate of 45%. And in the case of a company, it's going to be a proportional tax rate of 28%, which is, of course, at some point going to go down to 27%. Companies and CCs, we are thinking about like your banks, SAB, Discovery. I'm sure you can think of a whole host of other companies. But the most important things to keep in mind is firstly that a company, even though it's not a living human being, is a person for tax purposes. And because of the definition of company, we treat close corporations, CCs, as companies for tax purposes, which means the members of a CC is regarded as the same as the shareholders of a company. So because it's a separate legal entity, it's a separate taxpayer from its shareholders. So shareholders are not taxed on the profits of the entity, and an assessed loss cannot be distributed to shareholders or members. Companies do not qualify for interest exemptions or the annual rebates or medical tax credits. And any distribution of profits to shareholders are subject to dividends tax. And from a normal tax perspective, companies are taxed at a flat proportional rate of 27%, up to years of assessment ending before 31 March 2023. That was, of course, 28%. While farming operations is not technically an enterprise type, it is important that you are aware of the tax implications for persons who are interested in pursuing farming enterprises or who currently are trading, and have farming operations, because it is estimated that some 8.5 million people in South Africa are directly or indirectly dependent on agriculture for their employment and income. The food that we eat, all of those types of things come from farming activities. And if you are within, different provinces, particularly the Free State and the Western Cape, etc., then that forms a big part of the trade and industry within those specific provinces. So from a tax perspective, it's important to understand that farming operations can be conducted in any type of enterprise type. So you can be a farmer as a sole proprietor, in a partnership, or in a company or CC. Irrespective of which entity or enterprise type they use, farmers have special tax rules that apply to them. And this is because they are dependent on weather, and the weather is unpredictable. We've got climate changes that we have to, or that they have to contend with. And these special tax rules are set out in the first schedule to the Income Tax Act. Remember, there are a few factors to consider when selecting an enterprise type. Tax is definitely not the only factor. You have to think about things like liability, like flexibility, what are the administrative requirements, what are, are you planning to conduct a business where you are going to need to be audited, etc., etc. So do not let the tax tail wag the business dog. If you choose a business entity based on tax considerations only, your business will most likely fail.